Hey everyone, welcome back to the channel. If you've managed to save up your first $10,000, first of all, congratulations. Seriously, that is a massive milestone that most people never actually reach. But here's the reality, in 2026, leaving that money sitting in a standard savings account is basically throwing it away. With the way the economy is shifting, you need a plan that balances safety with high growth potential. Today, I'm showing you the exact blueprint for a 10K portfolio designed to thrive in today's market. Let's dive in. Before we buy a single stock, we have to talk about the mental bucket strategy. Investing $10,000 isn't just about picking winners, it's about asset allocation. In 2026, the landscape has changed. We aren't just looking at the S&P 500 anymore. We're looking at a world dominated by AI integration, energy transitions, and a new interest rate environment. We're going to split this 10K into 4 distinct buckets: the foundation, the growth engine, the passive income stream, and the speculative moonshot. This structure ensures you're protected if the market dips but positioned to win when it rips. First up, we're putting $4,000, that's 40% of your portfolio, into the foundation. This is your bedrock. In 2026, I'm still a huge advocate for a total stock market ETF like VTI or a low-cost S&P 500 tracker like VO. Why? Because these funds give you instant ownership in hundreds of the most successful companies in the world. Even with market volatility, the historical trend for the broad market is upward. This is the portion of your money that works while you sleep, compounding year after year without you needing to check the news every 5 minutes. Now, why 40%? Because as a beginner, your biggest enemy isn't the market, it's your own emotions. By putting a large chunk into a diversified index fund, you significantly lower your risk of losing everything. In the US, Canada, and the UK, these funds are the gold standard for retirement planning. You're betting on the entire economy, not just one CEO. If the market takes a temporary breather, your foundation stays solid. It's boring, but boring is exactly what builds millionaires over time. Next, we're moving to the growth engine. We're allocating $3,000 here. This is where we get a bit more aggressive. In 2026, we're focusing heavily on the Magnificent Seven and the next wave of AI infrastructure. Think of ETFs like QQQM or specialized tech funds. These companies are the ones driving innovation in robotics, healthcare tech, and renewable energy. Since you're likely in that 25 to 45 age bracket, you have the time horizon to ride out the swings in exchange for the massive upside these tech giants offer. But wait, don't just dump it all into US tech. To be a truly sophisticated investor in 2026, you need international exposure. I'd suggest taking $500 out of that growth bucket and putting it into an emerging markets or an international developed markets fund. Whether you're in Australia or the UK, diversifying outside of just North American companies protects you against a weakening dollar or localized economic shifts. Global brands in Europe and Asia are often undervalued and offer great dividends that US tech companies usually skip. Moving on to bucket number 3, the passive income stream. We're putting $2,000 into high-yield dividend stocks or REITs, real estate investment trusts. Even if the stock market goes sideways, these companies pay you cash just for owning them. In 2026, with inflation still being a talking point, having a cash flow element in your portfolio is a game changer. It's incredibly motivating to see those first few dividend payments hit your account. It proves that your money is actually a tool that generates its own income. For this bucket, look for dividend aristocrats, companies that have increased their payouts for at least 25 consecutive years. We're talking about the titans of industry: consumer goods, healthcare, and utilities. These aren't get-rich-quick stocks, but they are stay-rich stocks. If you're in Canada or Australia, you have access to some incredible banking and mining stocks that offer some of the best yields globally. This $2,000 acts as a stabilizer, providing a cushion when the high-growth tech stocks are having a rough month. Finally, we have the speculative moonshot bucket. We're putting our last $1,000, 10%, into high-risk, high-reward assets. In 2026, this usually means Bitcoin, Ethereum, or maybe a specific small-cap AI startup you've researched deeply. Let's be real, you're young, you want excitement, and you want the chance for a 10x return. By limiting this to only 10% of your portfolio, you get the thrill of the crypto market without risking your entire financial future if things go south. The key with this $1,000 is to set it and forget it. Don't day trade it. The 2026 crypto market is more mature than it was years ago, but it's still the Wild West compared to index funds. If that 1,000 turns into 10,000, your whole portfolio gets a massive boost. If it goes to zero, you still have $9,000 growing steadily in your other buckets. This is how professional wealth managers handle risk, and it's exactly how you should handle your first 10K. Now that you have your allocation, let's talk about the where. Choosing the right platform is crucial to avoid fees eating your gains. If you're in the US, platforms like Vanguard, Fidelity, or even Robinhood for its ease of use are great. In the UK and Europe, look at Trading 212 or Vanguard Investor. For my Aussies, Kamasisi or Perler are solid choices. The goal is to find a broker with zero or very low commissions. In 2026, there is absolutely no reason to be paying $20 a trade like it's 1995. One of the biggest mistakes beginners make is trying to time the market. They wait for a crash to invest their $10,000, only to watch the market climb another 20% while they sit on the sidelines. My advice? Use dollar cost averaging. Instead of dropping all 10K at once, maybe do $2,000 a month for 5 months. This smooths out your purchase price. If the market drops, you're buying more shares at a discount. If it rises, you're already in the game. Consistency beats timing, every single time. Let's talk about taxes for a second, because the government always wants their cut. If you're in the US, try to do this within a Roth IRA or a 401k if possible. In the UK, use your ISA allowance. In Canada, your TFSA is your best friend. Investing inside these tax-advantaged wrappers can save you tens of thousands of dollars in capital gains taxes over your lifetime. It's not just about how much you make, it's about how much you keep. Always check your local tax laws before you pull the trigger. To wrap this up, the most important step is actually starting. A lot of people watch videos like this, get excited, and then let the $10,000 sit in their checking account for another 6 months because they're afraid of making a mistake. Look, the perfect portfolio doesn't exist, but a started portfolio is the only one that builds wealth. You now have the blueprint: 40% foundation, 30% growth, 20% income, and 10% moonshot. Take that first step today. Your future self will thank you. If you found this breakdown helpful, do me a huge favor, hit the like button and subscribe for more finance strategies tailored for 2026. Comment below with the word investor if you're planning to hit your 10K goal this year. I try to reply to as many comments as I can to help you guys out. Thanks for watching, stay disciplined, and I'll see you in the next video.